Let's get across the market open. Mark Gardner joining us from MPC Markets. Mark, welcome to Monday, brand new trading week. We take a look at what happened on global markets, particularly Wall Street on Friday, some heavy falls there. So we are expecting a fairly, hotly negative start this morning.
Yeah, I don't think we'll see I don't think we'll see the sort of downside that the US has shown. Obviously, it's a fair bit there in the Mag 7. So we've had that's 6 weeks in a row down for the Mag 7 overall. And it's the first time that's happened since May in 2022. When obviously we were hit down, we got into bear market territory. Obviously, Trump doesn't help on those Friday nights because going into the weekend with 2 days worth of risk, it probably compounds, and we saw that the selling compounded into the close because I don't think the market's confident enough at the moment to risk 2 days of Mr. Trump. 48 hours the market's not being open, is a fair bit of risk when he can say a lot of things. So he's come around on the weekend saying he's pissed off at, and they were his words, not mine, at President Putin. So we'll probably see a little bit of lift in some of the defence stocks maybe. Defend is the way we're representing that as an ETF from Van Eck, which is highly allocated to European defence stocks and around about half in the US. But also, obviously, we've seen gold continue to rise. It's just breezing through 3,100 now. I think silver was a touch softer, but is sitting very close to 13-year highs. And we saw copper drift higher. So we've got Liberation Day, I believe it's called, or he's calling it, on April the 2nd, which is Wednesday. So look, there's going to be more uncertainty leading into that. But,
Wednesday our time, Tuesday theirs. Yep.
Tuesday theirs, right.
Yep. Great uncertainty. Obviously, investors perhaps positioning for what we're going to hear from Trump on Tuesday their time. In between time, though, look, there are growing concerns about the potential for stagflation.
There are, and stagflation is the worst possible thing for economies and markets, really. It's where you've got slowing growth, but you've also got inflation as well. So PCE numbers weren't out of control on Friday night. I think it was probably just a little bit of the straw that broke the camel's back. They're expecting those to come back down a little bit, particularly it was the core that sort of had people worried. It was a little bit hotter than expected, which may push out those, it really might push out those rate cuts that everyone was hoping for. I think at this stage, and I've said this a few times on the COB and the Monday morning, is that the focus really is shifting to the employment numbers. I think the employment numbers this Friday will be probably one of the larger most significant market movers for the following couple of months, really, because if we see a negative number, we haven't had a negative number since December 2020. There's been a long string, and those numbers have been revised down. But obviously, Trump's been in power now for well over 60 days, which is the threshold where they start to claim unemployment benefits. So those Doge cuts that everyone were lauding, are now possibly going to have a negative effect, depending on how they've structured those redundancies. They could have a negative effect on the payrolls numbers, and the media and the market pundits seeing a negative number. That'll make for a very big headline, I'd say, for next Monday. So I think risk off is still going to be, the theme this week. We're lucky enough that a big chunk of our market, being the materials sector, is going to probably benefit from China stimulus. And that materials sector it's already there. We're already in single digits. The banks have probably got a little bit more to come back. But I think where you'll see, the largest hits will be, those highly cyclical sort of consumer discretionary and tech names that have been sitting at record high PEs. I think there's a lot of wiggle room for those to come to be pulling back. But if you've gone to cash, you probably should be embracing and making a bit of a shopping list and planning to buy back into some of those high quality companies.
Just before we get a little more detail on positioning, then, Mark, locally. Obviously in the midst of the election campaign, I don't know whether that's actually influencing what you're seeing more broadly at the moment, but also a key event this week, tomorrow, with the RBA decision, although expectations they will stay on hold, but bets firming for a May cut.
Yeah, I think now the election's been announced, that really does. I think the RBA did the right thing. Essentially, if they knew that if they had to go, and circumstances are now looking like they needed to go sometime in this period before before the election's decided. I think that's largely been done because you could see from their hawkish rhetoric that they weren't comfortable with cutting, And I think they're probably breathing a sigh of relief now that they took the risk and cut rates. And I don't think now we won't really see them do anything until we get the election out of the way. So the election normally wouldn't, and particularly, and the budget as well, being a fairly populist budget with no real key changes, it's just uncertainty on top of uncertainty as it stands at the moment, and it's not really helping overall. If we were in a strong bull market, or say this was 6 months ago, I really don't think the election would affect the markets a lot. But I think it's just another factor that investors are going to be worried about, and it's sort of increasing that that market stress as it stands at the moment. So very good time to be obviously reviewing your portfolio, and particularly because we've had 2 fantastic years. The S&P had its best 2-year run since I think the mid-90s. So what you don't want to do is be stubborn at this point, and just hang on to things for the sake of hanging on. And there's absolutely no shame in going into a little bit of cash. I mean, we've got most clients at 30% plus, and we've got a fairly decent allocation to gold as well as it stands at the moment, because with President Trump in power, we're probably just going to have geopolitical flare-ups, for the foreseeable future. And just take your time, be patient, don't get caught in the down run. We've got a fair few education pieces on how to handle market risk and what to do in these situations on our website, which obviously didn't get a lot of clicks for the last 2 years while we've been rallying, but they're useful information now in terms of how you should be handling this, because you don't want to be giving back those profits, and sometimes you need to change your strategy for a period of time.
All right, so defensive side, you're talking about perhaps healthcare, consumer staples, also obviously talking about some of those commodities, gold, silver, copper. Are you playing that stock-wise, or are you getting a broader
copper particularly, we've got BHP, which is a staple in the portfolios and is at really cheap levels at the moment. We think particularly on a long-term basis, under $40. That's an easy one because it sort of pivots between them being the biggest copper producer and the second biggest in the world. Wire ETF is another good one as well, although some of those companies could be subject to tariffs, Capstone Copper is one that's got 30%. It's a dual listed here. It's a Toronto exchange, but they've got 31% in the US. Newmont also has a stockpile of copper as well. So you can play both the copper and gold thematic through those guys as well. And healthcare, CSL is obviously fairly cheap at the moment. But it sort of baffles me why it's sitting down here. It's probably one of their better reports at the last earnings. I would have expected it to be towards the top of the range.
Yep.
And the supermarkets now have the ACCC inquiry out of the way. That's not going to come round to bite them again, I wouldn't have thought, for the foreseeable future as well. So, Woolworths is very cheap here at the moment. Coles obviously doing a little bit better, but is a little bit more expensive as well.
And what are you looking to exit at this point, or what have you exited?
We've exited, and look, I probably exited a little bit too early. We didn't get the last sort of 10% of those moves in those high PE consumer discretionary stocks. We haven't really been in the banks. We exited WiseTech for other reasons, but we probably would have been back in by now had we not have seen this, this weakness in that tech sector. So, I think depending on your ethical filters, WiseTech's probably one under $80, and I think you'll start to see, the likes of Xero and Technology One having that broader market weakness sort of eat into the share price. But I think dollar cost averaging is very much the key. I don't think you want to pick a single point to get in because you don't know what's going to happen necessarily over the next few months. But if you sort of space out a plan and maybe split it, what you want your final holding to be, say it's $10,000 into $2,500 clips over the course of the next 3 months, you'll probably get a better result and reduce your stress quite significantly in terms of in terms of trying to pick the turnaround.